You're listening to the TCN Worldwide Market Minutes Podcast, the show that brings you commercial real estate market knowledge from around the globe. And now, here's your host, Eric Odom.
Hello, and welcome to another episode of the TCN Worldwide Market Minutes Podcast. I am the host, Eric Odom, and we cover commercial real estate tips and strategies from TCN professionals around the globe. Today, we are very happy to have with us Luke Timmis from Signature Associates in Michigan. Luke is the investment director of his firm. In 2019, Signature Associates completed 1,032 transactions totaling almost 28 million square feet and $1 billion in commercial real estate value. With over 8 locations in Michigan and Ohio and more than 130 CRE professionals, Signature is a proud member of the TCN Worldwide Network and is one of the largest independent brokerage firms in the U.S. Luke is joining us today to talk about Sale-Leasebacks, a strategy used by firms large and small to restructure their balance sheets and increase their cash position. The strategy has increased availability for investment assets for institutional and individual investors alike. Luke, hello, and welcome to the show.
Thank you, Eric. Appreciate it.
So, Luke, why don't you start at the beginning? You're providing a service for these corporations, and I think it's a cash flow solution that you're providing for them. But why don't you talk a little bit about why a corporation would be interested in selling their underlying real estate?
It's a great question, and there's a lot of different answers to the question. One I'll start with, which is just recent, one that I came across the other day, and we come across this all the time, is estate planning sale-leaseback. This is an interesting one where you have the CEO of a business, they created it from scratch. He's, say 65 to 70 years old. He wants to harvest the fruits of his labor, but his son is the president of the company or the vice president of the company. And he's got a daughter who's the head of sales or has another son that's the head of marketing. And it's a family business. They enjoy owning it. But at the same time, the dad built this business, beautiful business from scratch over the course of, say, 45, 50-year career. And he's looking for some sort of liquidation event. Now, I think traditionally the way people think is if you're going to sell your business or liquidate your business, you're going to have to do one of two things. One, you're going to have to sell your business or sell some equity in your business, right? Which if that occurs, you lose decision-making abilities and maybe your son and your daughter or, they're not on the payroll anymore as a result of that, right? So one is you give up equity and the other is you take on debt, bank debt. Those are the two traditional routes for a business owner to capitalize his position. Well, the proceeds from a sale-leaseback solves two different issues. Number one, you don't give up any equity in your business, the business that you built from scratch and that your family is continuing to live on, right? Number two, it's not bank debt, which bank debt has a ton of covenants. There's a lot of reporting. It's a lot different when you have proceeds or you have capital from a real estate investment trust than receiving a loan from a traditional bank lender with tons of covenants. So I think this has provided kind of just a unique liquidation event for business owners in that estate planning scenario. So that's just one scenario of many.
Let's talk a little bit about the type of company that might be interested in doing a sale-leaseback. Obviously, Home Depot, FedEx, these folks tend not to own their real estate. They get a property, they develop, it's a build-to-suit from the developer, or they might have purchased it, but they turn around and sell it to an investor because they don't want to hold those assets on the books. I mean, there's reasons that they can produce more out of their business than they can out of real estate. So they're very happy to sell those assets or to pass off the ownership of those assets onto the real estate investment group. Why don't you talk to us a little bit about what types of companies besides the large Fortune 500 companies can benefit from this type of transaction?
Sure. Yeah, that's a great question because at the most granular level, I think where sale-leasebacks originated, or at least the first point of where I had ever learned about sale-leasebacks in accounting was for machinery. So businesses used to do this for machinery all the time. Like they'd have a couple $1 million of metal stamping machines and they'd sell them and lease them back and get liquidity that way. So there are all kinds of people and investors at all levels, from the private capital level to the institutional level, that are looking to place capital. So there is a market, what I'm saying is, for small businesses to do sale-leasebacks. And the first sale-leaseback that I ever did was a $5.4 million sale-leaseback for a business that was doing, I think, $20 million in revenue, which is obviously nowhere near, $20 billion of revenue. So this is a much smaller company, but this is a company that was heavily dependent on the auto industry. That's where we are here in Michigan. We're, obviously Metro Detroit, very dependent on the auto industry, which in turn makes their business very cyclical. So to battle kind of the cyclicality of their own business, you can fortify your cash position by liquidating out of the real estate via sale-leaseback. So small companies can benefit from it too. And I think one of the things is, at that $5 million price point, this is a 80,000 square foot building, I'm pretty sure. At that price point, you're actually going to have a mix of like publicly traded REITs and private local investors also interested in that product. So I'd say anything under 2 million, it's probably a local crowd. However, there's a lot of local investors that are placing money in industrial investments right now all over the country.
Yeah. So you're going out and you're talking to the business side, talking to the CFOs and see if they might be interested in making a transaction. And then you're also tracking the individuals, whether it be the mom and pop investor or the REITs that might be buying, and you're getting both sides of that. So you already know when you're taking a product or taking a property and doing a sale-leaseback, which direction you're going to go to try to get it placed and sold. Is that accurate?
Yeah, absolutely. We have two interns here who we were talking about the other day. We had a pitch for a sale-leaseback in the Boston MSA. We landed the sale-leaseback. We priced it. And we put it out to the market. We basically predicted exactly how the process would go. We knew exactly where it would trade. We knew exactly how long it would take. We're in the midst right now of trying to close that transaction, but it's crazy. I mean, we had 20-something signed CAs in a week. We had 6 or 7 offers, mostly from institutional REITs. We're a familiar face in this space. So when we send out an email, we get instant CA signed. I mean, it's crazy. We spend all of our time in the weeds working with these REITs every single day. In fact, during COVID, one thing that we did was we set up bi-weekly calls with these REITs, basically surveying the group of REITs. So like 20 of them. We surveyed the whole group and then we reported back to the whole group a week later with our cumulative survey information, right?
Sure.
We're very embedded with the buyers for these deals, but we spend all of our time trying to dig up these transactions as well. So it's crazy. We're seeing 5 to 15 offers on every deal.
What type of company are you trying to go after that you believe would be the best fit for sale-leaseback?
We talked about cyclicality, cyclical companies. I think for us, we really think about who we want to target. We don't send out thousands of emails and thousands of calls. We've gotten really good at thinking about who we want to contact and how we want to contact them. And again, talk about it with the interns all the time. We've gotten really good at making the harpoon. The guys at our company used to rip on us. They said, if you do all this whale hunting, you're going to get slaughtered. And I've always responded with, well, if you're really good at making harpoons, it gets you a better chance of being a whale hunter. And so we created basically a platform where our cold calls to these companies come in the form of like a well-furnished, well-oiled, smoking hot sale-leaseback analysis. And for that CFO or for whoever that person is that we're giving it to, they're empowered with this information to go make decisions, right? And if it hits, it hits. If it doesn't, it doesn't. And that takes a lot of work. I'll tell you, 50% of my day is creating these decks, right? But that is our approach. I mean, we're really, really, really focused about who we reach out to and why. And I think cyclical companies is one. I spent a point of time just targeting food companies.
Like food wholesalers?
No, most of the cold storage
people,
industrial, food manufacturing and food distribution. That was just an idea that I had in a particular point in time and thought about who to reach out to. And we made some contacts in the space and we ended up transacting Ellison Bakery in Fort Wayne.
Okay.
It's a 136,000 square foot private capital deal. I think it's a $4 or $5 million deal. I think we transacted with the REIT on that one though.
Mm-hmm, mm-hmm. Talk to us a little bit about the tax implications of a sale-leaseback.
Tax in so many ways. Capital gains tax for the seller, the increase in real estate taxes that can potentially occur for the business. There's benefits, I guess, with the write-off of the lease, right? There's always going to be tax benefits with being able to write off a lease. but I wouldn't say that there's any real like tax advantage to this play. Now, I will say this. Again, another angle, another way that we've spun our business pitch is you've got a business owner who has a food business, Ellison Bakery in this particular case, right? They make cookies. And the owner builds this business from scratch. The business is headquartered in Fort Wayne. Most of its customers are in the Midwest or, Indiana area. And for him, the sale-leaseback was an interesting pitch because, maybe for him, he has this realization, these owners, they have this realization where your entire net worth is tied up in this business, in this location, right? I mean, you're not very well diversified in terms of your net worth as a business owner. But by selling the 136,000 square foot building at a premium, if the business is a solid business, that seller can take the proceeds and go do a 1031 exchange in a 20-year net lease FedEx in Miami, Florida. Mm-hmm. That's taking you to a different geography, to a different credit, right? FedEx is completely different than the cookie bakery, right? So you've now geographically diversified yourself. You've diversified yourself from a credit standpoint. And for some of our sellers, that's been kind of a route for them is sell out of my position in this real estate, this business essentially too, because really what it is, you're selling out of a portion of your business, your enterprise value. Right. And you're diversifying into another avenue, which, I think for a lot of people, it's an advantageous transaction.
Let's talk about a topic I think everyone is probably a little bit tired of hearing about, but it's sort of the elephant in the room. It's COVID. How is COVID affecting the demand for these sale-leasebacks and your business, if at all?
100%. It's totally impacted our business. We had we had a great first quarter, and then everything went dark. So the REITs, their stock price, if you were tracking it or anyone was tracking it during kind of the 10, 12-week COVID crisis, where we had the stay-at-home orders. And I'm not sure where you guys live and whatnot, but I'm talking about when it was most serious here in Michigan. Everyone was on the sidelines. The REITs, their stock price, if you were tracking it, it was up and down 5%, 6% every single day. And when your cost of equity is impossible to track like that, it's impossible to price deals. So you had 100% of the publicly traded REITs that were on the sidelines. I basically advised anybody that I was talking to at that time, if you don't need the money, let's wait it out. And that's proven to be a very viable strategy for us. The sale-leaseback that we recently took to market, we received 6 offers on it from REITs. So we're in a totally different place now than we were, say, 12 weeks ago. The REITs, their stock prices have stabilized, their cost of equity has stabilized. The debt markets, though, have absolutely impacted pricing. So the way that these REITs they're all financing these deals. They buy them all cash, but they finance it thereafter. And on these transactions, like a year ago, sale-leaseback might get 80% financing non-recourse. Today, at this second, you might be getting 60% leverage. And that obviously impacts your cap rate a little bit. So I think across the board, to just give you kind of a gauge, 100 to 150 basis points, it's 1 to 1.5% cap rate swing from where we were pre-COVID to where we are now. 7 cap deals are 8 cap deals now. 6 cap deals are 7 cap deals. That's what we're seeing in the market.
Pricing in the additional risk. Yeah.
Absolutely. But interestingly enough, there are some businesses that are absolutely crushing it. The stay-at-home staycation has absolutely pushed the sales of pool equipment is going off the charts right now. Another sector that's doing well is the DIY culture. Everyone's at home. They're stuck at home. The do-it-yourself, building this, constructing that. Those projects have created a demand for certain products that are needed for your hammers and kind of these do-it-yourself items, right? And it's the sales of some of these items have gone up. I told you pool stuff has gone up. Obviously, COVID has created a lot of negativity in the market. There's always going to be a huge blip in everyone's profit and loss statement for this particular point in time. But I think in every point in time, there's opportunity. And going back to one of your other questions, who are you targeting? Well, a dramatic change in the market creates a dramatic change in the angle that we pursue business, right? So trying to find COVID-resistant businesses is probably one of the strategies that we're trying to implement right now, right? That shows really, really well.
Talk to us a little bit about structure of these leases. What about rent bumps? How long are the terms typically? What do the buyers of these investments want to see? And then how do the sellers, the people who are doing the sale-leaseback, how do they want the deal structure? Why don't you talk about both sides?
So the seller obviously wants to sign a 1-year lease at very low lease rate in theory, right? On one side of the spectrum, one extreme, they want low lease term, low lease rate, and they want a high price. I mean, in theory, but really, if you want to institutionalize the process like we do, you have to extend that lease out to 12 years. It's got to be a 12-year lease. And the reason for that is because the institutional buyers, the publicly traded REITs, real estate private equity funds that are targeting these transactions, they're financing these deals with 10-year debt. 10-year loans. So if you have a 10-year loan maturity and a 10-year lease maturity occurring at the same time, you create a ton of problems for yourself. Or say a 7-year lease expiration with 10-year debt, you create an even bigger problem. So the institutional REITs simply cannot invest in sale-leasebacks with less than 12-year term for the most part. And that is mostly for like the type of credit that we're talking about, these smaller middle market companies, right? For a 10-year Amazon deal, sure, like a REIT will take a chance on that.
Talk to us a little bit about the seller side of that. I mean, obviously, they want the lowest lease rate. They want the lowest cap rate so that they're pricing it. And then so how do you combat that gap that typically exists between what the market would pay for that asset and that lease and reconciling that with the seller who might be a little bit unrealistic?
Yeah, it's a great question. You don't want to get crazy with this. You really got to understand how to price these things and pricing them the right way. But when we talk to sellers, we basically say, this is the general range of lease rate for this particular market. This is kind of a base case or low end. This is a middle end and then a high end, right? And then we provide them with a valuation range. And that valuation is predicated almost entirely on business financials. So that's what makes our group different than others. I mean, where most investment sale groups are underwriting to NOI, we're underwriting every day to EBITDA. The only financials really that matter to us, obviously the underwriting for a sale-leaseback is quite simple. It's rent divided by cap rate, right?
Sure.
But the biggest driver for us is the creditworthiness of the business. And so determining that lease rate is actually extremely important for the financial health of that business, right? It's like, if you can't go through those financials and understand that a $5 lease rate is way too high for this business, that's probably not the underwriting that you should be applying, right? You should probably be using a lower lease rate that helps them cover the lease in a better way, right? And that's what the REITs want to see. They want to see good rent coverage. They want to see good debt coverage. They want to know that this business is going to stay there for a long time. So with that said, we basically provide them with a scenario that says, if you want to absolutely maximize your proceeds in the biggest way possible, this is the range. If you want to preserve the margins of your business, this is the range.
Talk to me a little bit about, on the tenant side, who's going to be that ideal fit in the tenant world for you? You're saying that it's going to be someone who's showing levels of profitability and cash flow. That would be important on the investor side. Probably it's not a great idea if someone's had 3 to 5 years of losses and are distressed to be trying to do a sale-leaseback. It might be a tough placement.
Right. I mean, I'll give you another story. We had a company that was going to file for IPO. And before they did the IPO, they had to grow their business a little bit. And we did sale-leasebacks on the 3 competitive businesses that they bought. That was a mature business, really solid financials, pre-IPO company. They were using the proceeds of the sale-leaseback to kind of grow the business and launch this IPO. I love that scenario, personally, from our platform, way better than the company that's shown 5 years of losses, right? Although we have dealt with those too. We did a bankrupt paper company too.
How about the small coffee shop operator? He's got 3 locations. She's got 3 locations. And they own each one of those locations, and it's worth $1.5 million. Is that a deal that you would touch, or is that something that you're like, no, that's too small for our investors?
For us, we couldn't really add value for you there.
Okay.
But I'll tell you what, I mean, there's so much business there. There's so much business there for exactly what you're talking about. The coffee shop owner with 3 locations, he owns his buildings. They're 3,000 square foot buildings. They're well located. There isn't an institutional audience for a $800,000 or $1 million deal, but there absolutely is. And everyone knows, anyone that's listening to this, they know that there is definitely a local audience for those little investment deals, for sure, especially when you structure it the way that I'm talking about. You take a small deal and you institutionalize it with a 15-year lease, you're really going to get the local private crowd very excited about that deal. So I think there's opportunity there to create a competitive process, even though that deal size is smaller. But for our particular platform, that probably wouldn't be a good fit.
Understood. So why don't you talk to us a little bit about how folks would get in touch with you if they're interested in either doing a sale-leaseback or they're potentially interested in purchasing deals that you're putting together?
Absolutely. I think email or call, is always the best way to reach out to us. My personal email is on our website, but it's L as in Luke, Timmis, T as in Thomas, I, M as in Matthew, M as in Matthew, I, S. So it's L Timmis at signatureassociates.com. That's my email. My partner's email is gpitcher at signatureassociates.com. His name's Griffin Pitcher. He's a stud. He couldn't make it today, but got to give him the shout out. That's for sure.
Let's talk a little bit about Signature and where you guys are operating. Signature is a fairly large brokerage firm in Michigan. So why don't you talk about your coverage area and what other asset classes that the firm engages in?
We do everything, full service commercial real estate firm. We do brokerage for retail, industrial, office, both user sales and leasing. And then we do investment sales as well. That's my division. We also do property management. And then we have 8 offices in Michigan and Ohio. So we're actually one of the few large privately owned brokerage companies out there right now. And we're actually damn proud of it.
You do have a platform through the TCN, and you guys have been members of TCN for a number of years. It's great to have you participate and be adding value to the worldwide network.
Absolutely. It's been a good ride with TCN, that's for sure.
Luke, appreciate your time. Did you invest with us today? Is there anything else that you'd like to leave our listeners with?
I told my brother I'd give him a shout out, Liam, and his fiance, Morton. Shout out, what's up? And thank you for listening. Really appreciate the time, Eric. It's a blessing and really appreciate it.
Thank you, Luke. And that was Luke Timmis from Signature Associates in Michigan. For more great topics on markets around the world and ideas on commercial real estate, please visit our website at www.tcnworldwide.com. We appreciate the time you have spent with us today. So until next time, we wish you great success and thank you for listening.
Thanks for joining us this week on the TCN Worldwide Market Minutes podcast. TCN Worldwide is an alliance of top independent brokerage firms serving more than 200 primary and secondary markets worldwide. Make sure to visit our website, tcnworldwide.com, where you can subscribe to the show and find additional market reports and commercial real estate updates from around the globe. While hosts and producers of the TCN Worldwide Market Minutes show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts or producers of the TCN Worldwide Market Minutes podcast.